Well, US 10-year and 30-year Treasury yields have hit fresh multi-year highs. Strong US data has heightened concerns about rising inflation and a potentially faster pace of rate rises by the Federal Reserve. Well, Joumanna has been delving deep into why investors should be bullish or bearish around the markets. She joins us from the wall. Joumanna, good morning.
Morning, Karen. Yes, indeed, that 10-year note is back at 325, which is a level we've not been at since 2011. So lots of questions and lots of scrutiny really on what is going on here and the implications those higher yields are going to have on other markets, particularly equity markets, which obviously have retraced a little bit in the last few sessions. So let's start off by talking about some of the bearish drivers here. What are the reasons behind the sell-off we've seen in US Treasuries over the last couple of weeks or so? We have moved higher to the tune of about 50 basis points since end of August. Number one reason that I would point to is the extra issuance. This year we're seeing a big amount of government spending. If you look at it from a numbers perspective, in the last 12 months alone, there's been an extra $1 trillion worth of net issuance since last October. This is the highest level of issuance coming out of the US since 2012. Obviously, that paper needs to be absorbed somewhere. It's coming at a time when the Fed are reducing their balance sheet. This is quantitative tightening. That is where it comes from. And the impact that it's going to have, obviously, is that supply doesn't actually have a buyer to go once the Fed is stepping out of that turf. The implication, of course, is that that's going to have knock-on effects on the US dollar as well. US dollar is becoming a lot richer, and what that means is funding is becoming a lot more expensive, which means that from a positioning perspective, it becomes a lot more trickier and a lot more expensive for foreigners to buy and to own some of that debt. If you look at some of the positioning data, the CFTC data that comes out on a weekly basis, it does point to a further sizable positioning, short positioning in the TY contract, or the 10-year part of the curve. Tells you that from a duration standpoint, investors do want to be short and do want to be underweight duration at this point in time. And finally, the inflation numbers have been picking up. If you look at things like the core CPI print is coming in at 2.2%. It's been above 2% for the last 6 months. Average hourly earnings, if you look at the NFP numbers, drill a little bit more into the details there, we're pointing to 3.5% on the wage growth side. So all of these are factors for one to be bearish the bond market in the US. But let's talk about some of the other factors, and these are the reasons to be bullish that you can sort of weigh up against it. And one of them is the fact that globally now we're beginning to see some analysts revise down, lower their estimates for growth forecast. We saw it out of the IMF today, a downward revision to their global GDP forecast for 2019, led by the US, led by China, led by other emerging market currencies, economies as well. That clearly will have an impact on appetite for paper and also on how far these yields can go. Fed hiking cycle, I talked about the strength of the US dollar, but if the sentiment changes and if people think that the Fed are getting close towards the end of this hiking cycle, well then there are only so many places that yields can go, given that people will sort of have to reevaluate where interest rates can get to and where the neutral rate will be. Finally, lower rates globally. We have to think about US Treasuries in the context of global bond yields. And here I think it's interesting because still in this environment, about 25% of global bonds are still in negative rates territory. So in that environment, with you've got 2-year Germany trading at minus 60 basis points and 2-year US Treasuries trading at 2.5%, 3%, there, of course, that gives you an incentive just from a pure yield pickup perspective to get redeployed, to redeploy back into the US market. And of course, this is capturing the attention of asset allocators, pension funds as well, looking at the long end of the US market and saying, perhaps this is a good time for me to start de-risking, take some chips off the table, take some money out of equities and redeploy them back into the bond market as well. So globally, these are the pictures to be bearish and bullish. Fixed income here. Generally, though, we have seen a big move, and from the chats that I've had to people in the market, it does seem as though some people are taking some chips off the table, but of course keeping a good eye out for where the direction of travel is from here.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.